What if I told you the S&P 500 is trading around 7,165.6 right now, and an institutional algorithm has a 100% mathematical guarantee it's going up today?
Yeah.
But the human risk manager is absolutely refusing to buy it.
It completely breaks your brain, right? I mean, we're taught that if you have the answers to the test, you fill in the bubbles and you win.
Right, exactly.
If the market is going up, you buy. Simple as that.
But today, you're going to see exactly why that retail mindset is just the quickest possible way to zero out your trading account. Because having the answer, it doesn't matter if you execute it at the exact wrong microsecond.
Which is what we are digging into today.
Yes, welcome to the First Coffee. We are opening up a live, highly technical institutional battle plan. Specifically, we're doing a deep dive on the Alpharoot Consolidated Intraday Report for the New York session, dated April 27th, 2026.
And look, we really need to emphasize the word preliminary here. This is a preliminary report.
Super important point.
Right. This isn't the polished, validated strategy document that gets pushed to all the broad institutional clients at 9:00 a.m.
No, this is raw.
Exactly.
Okay.
This is the raw, unedited, over-the-shoulder view of a professional risk manager's New York desk at the precise moment they are handed this chaotic, shifting global market board from London.
That's the time zone handoff. So it's roughly 7:30 a.m. in New York, right before the cash markets open. London is winding down. They've been moving, billions of dollars for the last 6 hours.
Yeah.
And the New York desk is just sitting down, coffee in hand, staring at the aftermath. And they have to decide right now what is actionable and what is literally just noise.
And to do that, the Alpharoot system uses this really strict hierarchy. It's a triage system based on tiers. Because to a professional risk manager, all assets are just not created equal.
Right, regardless of how famous they are.
Exactly. They don't care if an asset is trending on Twitter. They only care if the math is offering an asymmetric edge at this precise moment.
Which is really the overarching mission of our briefing today. By the time we finish unpacking this document, you, the listener, will understand how to look at a chaotic market filled with conflicting signals and filter it instantly. Just like an institutional desk.
But I have to admit, looking at the triage list right out of the gate, I am genuinely shocked by what they are throwing into the waiting room today.
Oh, you mean Tier 3, the observation list?
Yes, the do not touch list. I mean, I'm seeing absolute titans here. The Dow Jones, the US 30 is in Tier 3, gold is in Tier 3, silver, Ethereum.
It's wild.
It is. If an asset is incredibly famous and hyperliquid like gold or Ethereum, there's always someone buying and selling, right?
There's always volume.
So why wouldn't a New York desk trade it every single day? Why bench your star players?
Well, because volume does not equal a directional edge. In fact, extreme popularity can be a massive deterrent. So a highly liquid asset like gold is always moving, sure. But on a day like today, April 27th, the underlying market structure just isn't offering a clean, defensible entry point. The desk is explicitly telling its traders that stepping into gold today isn't a trade at all.
It's a coin flip.
Exactly, it's a coin flip. And institutional risk managers, they do not flip coins.
So if institutional money is actively sitting on its hands with these massive assets, we really need to understand the mechanics of why. Let's look closely at the Tier 2 and Tier 3 assets in this preliminary report.
Yeah, this brings us to a concept I want to spend a lot of time on today, the brutal discipline of waiting. So the Tier 2 list, which they categorize as having a directional bias, includes the S&P 500, dollar-yen, Bitcoin, cable, which is the pound-dollar pair, and dollar Swiss.
And when you combine that with the Tier 3 observation list we just talked about, the Dow, gold, silver, Ethereum, you see this glaring, unavoidable commonality across all of them today.
Right. Under the parameters for action, every single one is explicitly set to wait. The mode is wait. And the scenario is almost universally listed as rotation.
Rotation basically meaning the price is just ping-ponging back and forth between two walls, right? Like without actually going anywhere structurally.
That's the baseline definition, yeah. But it's actually more sinister than just moving sideways.
What do you mean?
Rotation means the market makers are actively hunting liquidity within a defined box. So they push the price up just enough to trigger the breakout buyers, then they instantly slam it down to hit their stop losses.
Oh, wow.
And then they reverse again to trap the short sellers. It is a literal intraday meat grinder designed to extract capital from impatient traders.
Which brings us back to that wild statistic you mentioned right at the start of the show. That strong bias without New York edge paradox. Let's really dissect the S&P 500 data here.
Let's do it.
The report lists the S&P's bullish bias confidence at a perfect 1.00.
Right.
That is a 100% algorithmic confidence that the structural direction of the entire U.S. stock market is up.
The broader macro narrative is completely aligned. The desk fundamentally believes, based on the models, that the S&P 500 wants to trade higher over the coming days or weeks.
But the immediate priority action is screaming, wait. The note explicitly says, and I quote, "No clear New York edge. Stay in wait mode until valid confirmation appears."
Yeah.
How do we reconcile that? You have a machine telling you it's a structural guarantee to the upside, but the risk manager is barring the door.
Because this is the exact dividing line between a professional and an amateur. An amateur looks at a 1.00 bullish bias, logs into their brokerage, and hits buy at market, just assuming they're safe.
Right.
But the professional knows that conviction in a broader direction has absolutely nothing to do with whether a safe entry point exists right now.
Because of that intraday meat grinder you just mentioned, CHOP.
Exactly. You can be perfectly right about where the S&P 500 will be next Friday. But if you buy it blindly at 9:30 a.m. today, the algorithms that control the order book are going to sense your poorly placed stop loss.
Oh, they definitely will.
The market will violently drop 30 points, stop you out, take your money, and then casually reverse and hit your target later in the afternoon.
So you were 100% right on direction, and you still lost your capital.
Completely.
Okay, I want to make sure I'm fully grasping this. Let's say I have an inside tip that a specific horse is absolutely going to win the race. I have that 1.00 confidence.
Okay.
But when I get to the betting window, I realize the track conditions right at the starting line are a complete mud pit, and my horse might slip out of the gate before it even starts running. Even with my inside tip, the immediate tactical risk is just too high. I have no operational edge.
That is a fantastic way to visualize it. The macro destination is guaranteed, but the micro pathway to get there is just full of landmines today.
Right.
And for the S&P 500, the Alfred preliminary report outlines the exact dimensions of this minefield. The current price is around 7,165.6. But the base case scenario projects nothing but rotation between 7,103.1 and 7,168.1.
I'm looking at that 7,168.1 level. It's noted here as the previous day high, and the report says it was already swept.
That is the critical piece of the puzzle. The S&P basically poked its head above yesterday's high, checking to see if there were aggressive buyers willing to keep pushing it.
Just testing the waters.
Exactly. It swept up the liquidity resting above that level, but it didn't find sustained buying pressure, so it retreated back into the range.
Deciding it's too cold to swim.
Yeah, and until it could break out and confidently hold ground outside of that 7,100 to 7,168 box, the risk manager knows it's just going to chop people up. So the order stands. Wait.
That makes total sense for the equity side. But when we slide over to the crypto assets in this waiting room, the justification changes entirely, and I think it's fascinating.
It really is.
Let's look at Bitcoin and Ethereum. Bitcoin is currently sitting around 77,827.1. It's stuck in a range between roughly 77,300 and 78,480. But the diagnosis for why they are waiting isn't about a swept previous day high. It's entirely rooted in the time zone handoff.
Yeah, there is a fantastic note in the raw data here. It's actually written in Spanish, which isn't uncommon for global desks that integrate analysts across different hubs. It says for both BTC and ETH, London ya se expandió significativamente, meaning London already expanded significantly.
Which completely shatters the myth that crypto is just this untethered, floating 24/7 market that doesn't care about human clocks.
It's a huge misconception. Yes, the servers process Bitcoin transactions around the clock, but the actual human beings moving $50 million blocks of capital, they sleep.
They commute.
Right. They operate in distinct geographical time zones.
Yeah.
If the institutional players in London log on and drive a massive, violent, directional move in Bitcoin and expansion, they use up the market's immediate kinetic energy.
Kinetic energy, meaning the actual available capital willing to aggressively hit the buy or sell buttons at that moment.
Exactly. Markets need fuel to move. London spent the fuel. So when New York traders sit down at their desks, turn on their screens, and look at Bitcoin, they see that the massive move already occurred while they were on the subway.
Right. And the immediate reaction for a retail trader is FOMO, fear of missing out. They see a giant green candle and they just buy it, trying to catch the tail end.
But the New York institutional desk looks at it and says, the party's over, London drank all the good stuff.
They refuse to chase the ghost of London's momentum.
Never. Because if New York buys after London has already significantly expanded, they are structurally buying the top of the move. They're literally providing the exit liquidity for the London traders who are cashing out their profits.
Wow. So instead of chasing, New York diagnoses the asset as being in a hangover phase.
Yeah, the market needs to digest that massive move, which results in a tight, choppy rotation.
And across all these Tier 2 and Tier 3 assets, whether it's the S&P, gold, Bitcoin, or dollar yen, the risk manager has explicitly listed a parameter called mistake.
Oh, this is my favorite part of the document.
It's like a psychological warning label pasted on every asset, and it is a constant beating drum, trading without edge / without confirmation. They are literally hard-coding behavioral psychology into a quantitative data sheet.
That's because the biggest risk to a trading desk isn't the market. It's the trader's ego.
Right.
The institutional desk views the absence of an edge as an active, deliberate position. Wait is an execution strategy. It honestly requires way more discipline to stare at a flashing screen for 8 hours and do nothing than it does to click a button.
I want to dig into that edge, though, because reading the raw data for Bitcoin specifically, I caught a conflict that I'm having trouble wrapping my head around.
Okay, let's hear it.
So Bitcoin is in Tier 2. The report explicitly states the pre-market decision, the structural bias is bearish. The wider time frame says Bitcoin wants to go down.
Yep.
But right next to that, there is the alpha score. Now, the alpha score is their proprietary quantitative metric, right? It's the algorithm spitting out a probability.
Right.
The alpha score for Bitcoin today is BUY 62.5%.
Ah, yes. That is a glaring contradiction.
Exactly. If I'm a risk manager and my structural roadmap says we are bearish, but my highly expensive math algorithm says there is a 62.5% probability that I should buy right now. How do I synthesize that? Are the models broken? Which one do I trust?
The models aren't broken at all. They're just measuring two entirely different dimensions of time. This is the exact reason the asset is locked in wait mode. You are looking at a textbook time frame conflict.
Break that down for me. What is the algorithm actually reading that the structure isn't?
So think of the bias as your higher time frame macro weather report. It looks at the weekly and daily charts, the broader macroeconomic conditions, the vast pools of liquidity resting thousands of points away.
Okay.
That macro report says a massive storm is coming. We are bearish. The alpha score, however, is a micromomentum indicator. It's looking at the real-time order book depth, tick velocity, and delta divergence over the last 15 minutes.
So the alpha score is incredibly short-sighted by design.
Completely by design. It's looking out the window right now and saying, for the next hour, there is a break in the clouds. It's sunny. Buy. The 62.5% alpha score is just picking up on short-term buying pressure, maybe some algorithmic covering or retail participants trying to catch a small bounce.
So the macro weather is a hurricane, but the micro momentum is a temporary ray of sunshine.
Exactly. And when your macro weather report violently conflicts with your micro momentum, what happens in the market? You get chop, you get noise,
You get chewed up.
you get price action that rips upward for 10 minutes, trapping buyers, and then violently crashes down in alignment with the macro trend, trapping the sellers. A professional risk manager demands total alignment. They want the alpha momentum and the structural bias pointing the exact same direction before they commit millions of dollars.
And when the signals fight each other, the answer is always to sit on your hands.
Always. Wait for the rotation to resolve.
This is a preliminary briefing. For the final, validated 9 AM report, visit alpharoot.vercel.app.
Okay, so that perfectly transitions us out of the waiting room and into the actual execution zone. Because while half the board is locked in this conflicting chop, there are assets today where the macro and the micro are perfectly aligned.
Right. If institutional money is actively avoiding the S&P in crypto, where is the kinetic energy actually flowing? What are they allowed to trade today?
That brings us to the Tier 1 assets. This is the top of the triage list. The assets where the desk actually sees a quantifiable, defensible operational edge. These are the patients pulled from the waiting room and prepped for immediate surgery.
And today, the primary focus for what they call expansion setups, meaning they expect a violent directional move out of a range, are currency pairs.
Yes.
Specifically, we are looking at the Kiwi, which is the New Zealand dollar versus the US dollar, and dollar CAD, the US dollar versus the Canadian dollar, or the loonie pair.
Let's dissect the Kiwi first, because the posture the New York desk is taking here is remarkably aggressive.
It really is. So the current price for the Kiwi is trading around 0.591100. The key level they are watching is just a hair above it at 0.591250.
Right.
And the crucial note in the diagnosis is London High swept. The base case is a post-breakout continuation, requiring it to hold above 0.588190. But the most important parameter here is the action. It isn't wait, it is execute on trigger, and the mode is execution.
Now, I want to contrast that immediate aggression with the dollar CAD setup. The current price for dollar CAD is 1.36089. The key level is 1.36660, but the note here doesn't say swept, it says London High resistance.
Okay.
The base case is a post-breakdown continuation holding below 1.3662, and the action here is different. Setup wait trigger for a sell.
Okay, I really need to understand the mechanical difference between execute on trigger for the Kiwi and setup wait trigger for the Canadian dollar. They're both tier 1, they're both expansion plays. Why the different posture? I feel like the answer is buried in that phrase London High swept versus resistance.
It absolutely is. It comes down to the physical mechanics of liquidity sweeps, which is arguably the most important concept in modern algorithmic trading.
Walk me through it.
Let's imagine you are an institutional market maker, and you need to buy a massive amount of the New Zealand dollar. If you just hit the market and buy it all at once, you will cause the price to skyrocket, and you'll end up paying terrible prices for the top half of your order.
You'd cause massive slippage against yourself.
Right. To get a good average price, you need to find a pool of existing sell orders that you can buy into. Where do retail traders and smaller funds put their sell orders? They put them as stop losses just above obvious recent highs.
Oh, and the London High is a glaringly obvious target.
Exactly. Everyone who is shorting the Kiwi put their protective stop loss right above the highest price London reached.
So a stop loss for a short seller is essentially a forced buy order.
You nailed it. So what does the market maker do? They intentionally push the price up just past that London high. This triggers an avalanche of forced buy orders from all those stop losses.
Right.
The market maker stepped in, uses that avalanche of liquidity to fill their massive position, and then immediately drives the price back down, or, in this specific case, uses that gathered fuel to ignite a true breakout.
It's like a runner dropping back in a relay race, just far enough to grab the baton from their teammate before sprinting forward. You have to go slightly backward to get the fuel you need to go forward.
That is exactly how a sweep functions. And for the Kiwi today, the preliminary report explicitly notes that the London high swept has already occurred.
The baton has been passed.
The fuel has been acquired. Because the trap has already been sprung, the desk is highly confident that the true directional move is imminent. Therefore, the posture is aggressive. Execute on trigger. The moment their micro-criteria align, they aren't hesitating. They are firing.
But Dollar CAD hasn't grabbed the baton yet.
Correct. For dollar CAD, that key level of 1.36660 is acting as resistance. It means the price has come up to the ceiling, bumped its head and backed away, but it hasn't broken through to trigger the stop losses sitting above it.
So the fuel is still sitting up there untapped.
Which presents a very dangerous scenario for a New York risk manager. If they heavily short dollar CAD right now, a random algorithm might decide to push the price up 10 pips to sweep that ceiling, grab the liquidity, and only then drive the price down.
Oh, and if New York enters too early, they become part of the liquidity sweep. Their stop losses become the fuel.
Exactly. That explains the setup wait trigger action. They are building the parameters of the trade. They know exactly what they want to do, but they are keeping the safety on the weapon until they see how the market interacts with that ceiling.
And look at how the psychological mistakes align with these postures. For the Kiwi, where they are primed to execute, the warned mistake is fighting the structure bias. They are telling their traders, the liquidity is swept, the structure is clear, do not try to be a hero and counter-trend trade this, get on the train.
But for dollar CAD, where they're waiting for the setup, the mistake is listed as trading without confirmation. They are explicitly warning the desk not to jump the gun and anticipate the move before the ceiling is either firmly rejected or swept.
Let's take this a level deeper, because the data point for dollar CAD is staggering. Take a look at the alpha score for that specific pair.
I see it. The alpha score is a 90.4% sell.
A 90.4% probability generated by a proprietary quantitative model. That is incredibly high conviction. The algorithms are screaming that dollar CAD is going to drop.
Which raises an obvious question, right? If a multi-million-dollar algorithmic model, utilizing deep learning and analyzing millions of order book, ticks a second, is 90% certain the market is going down, why even have a human risk manager involved? Why not just let the machine auto-execute the trade with maximum leverage?
Because an algorithm calculates probability based on historical patterns, but it cannot account for a fundamental shift in real-time market reality. That is why the human risk manager demands a hard exit, an invalidation level. Look at the invalidation parameters for that 90.4% sell signal.
It says the entire setup is invalidated if there's sustained acceptance above 1.3662.
This is the core of institutional survival. It doesn't matter if your edge indicator is at 90%, 95%, or 99%. An institutional desk never takes a position without a hard line in the sand. Invalidation is not a gentle suggestion. It is a structural, non-negotiable mandate. If the price crosses above 1.362 and holds there, the math that generated that 90% score is proven instantly wrong in the present reality.
And the human risk manager forces the algorithm to take the loss and shut down.
Immediately. They do not average down. They do not hold in hope. If the invalidation level is hit, the thesis is void, and they exit.
I think there is a profound takeaway here that extends far beyond the financial markets.
Yeah.
The idea of setting a strict invalidation level before you embark on a decision.
Oh, absolutely.
How often in business, in project management, or even in our personal lives, do we stick with a failing strategy simply because we were 90% sure it was a good idea when we started?
We fall in love with our initial conviction. We let the memory of that 90% confidence blind us to the new negative data right in front of our faces. We throw good money or good time after bad.
But the institutional framework operates with zero ego. The trader says, I was incredibly confident, but the reality crossed my invalidation line, so I am out, completely emotionless. It's a psychological superpower.
And that superpower relies heavily on defining exactly what constitutes an invalidation. You read a phrase a moment ago that appears repeatedly across this entire preliminary document, and it is the absolute bedrock of how these institutions confirm a move.
Sustained acceptance.
Yes. Let's shift to the final group of assets in the report to really understand what that phrase means in practice.
Read the full final report at alpharoot.vercel.app.
Welcome back. This brings us to the remaining Tier 1 assets, which the AlphaRoot desk characterizes as operating in a normal flow context, as opposed to the explosive expansion context we just covered with the currencies.
Right. The normal flow list includes the US 100, which is the NASDAQ, the Aussie, the Australian dollar versus the US dollar, and the Euro dollar.
Normal flow implies a more methodical, structured trend environment. It's not a violent breakout. It's a staircase climbing higher or lower.
Let's run down the data for these three. The NASDAQ is currently trading around 27,480.4. The operational conclusion states it needs a post-breakout continuation, holding above 27,457.8.
Okay.
The Aussie is sitting at 0.718390. It requires continuation above 0.715430. And the analyst notes specific strong algorithmic buying pressure at positive 0.208.
Yeah, I see that.
And finally, the euro dollar is at 1.17405, needing to hold its ground above 1.1722.
Across all three of these Tier 1 normal flow setups, the invalidation parameters explicitly demand sustained acceptance. The NASDAQ setup is killed if there is sustained acceptance below 27,457.8.
What does that actually look like on a chart or an order book? Because I know retail traders constantly complain about getting faked out. They see the price cross a key line, they jump in, and immediately the market snaps back in their face.
The fake out is exactly what institutional sweeps are designed to do. A retail trader looks at a chart, sees a 1-minute candle spike through a resistance line, and their brain screams, "Breakout!"
Yeah, and they hit buy.
They buy the absolute tip of that spike. But an institution knows that a momentary spike is meaningless. It's just a probe to see if there is resting liquidity. Sustained acceptance means the price not only crossed the line, but it stayed there, absorbed the counterselling pressure, and stabilized.
Right.
The report specifically references M5 closures 5-minute candles. The market participants have to structurally agree over a sustained period of time that this new higher price zone is fair value.
It reminds me of the bouncer at an incredibly exclusive VIP club. Let's say there's a velvet rope, which represents our resistance level. A price spike is like someone rushing the door while a VIP is walking out, managing to stick their foot inside for 3 seconds before the bouncer aggressively shoves them back onto the street.
I love that analogy.
That's a fake out.
Yeah.
You crossed the line, but you didn't have sustained acceptance. You got the spike, but you got rejected.
Right. Sustained acceptance means you walked up to the bouncer, handed over your ID, he unclipped the velvet rope, let you inside, you walked calmly to the bar, ordered a drink, and you are now comfortably sitting in a leather booth.
The market has accepted your presence in that new zone.
That is precisely how a New York risk manager views the order book. They are looking at the NASDAQ, the Aussie, and the Euro, and insisting that they are only aligned with bullish continuation if they see that confirmation. They want the asset to get past the bouncer, buy a drink, and sit in the booth before the desk commits a single dollar to joining the party.
But speaking of the NASDAQ, I really have to challenge this setup, because reading the diagnosis line for the US 100, I see another glaring contradiction, similar to the one we saw with Bitcoin, but fundamentally different in its mechanics.
Okay, let's hear it.
The NASDAQ is listed as a Tier 1 asset. It is on the primary watch list for actionable execution today. The alpha score is a screaming 100% BUY. But under the diagnosis section, the structural bias doesn't say bullish. It says bias bootstrap in progress, awaiting confirmation. And the bias parameter itself is listed as neutral.
Yeah.
How can the NASDAQ be a top priority Tier 1 execution if the structural bias is neutral and still bootstrapping?
What a fantastic catch. And it perfectly illustrates the incredibly complex nuance of index trading right at the market open. Understand what a bias bootstrap is, you have to understand the physical transition of capital at 9:30 a.m. Eastern Time.
The cash open.
Exactly. Before 9:30 a.m., you are trading overnight futures contracts. The volume is relatively thin. It's mostly global institutions hedging their books. But the moment the bell rings at 9:30, the underlying cash equities, the actual shares of Apple, Microsoft, and NVIDIA open for trading.
Right.
Massive tidal waves of mutual fund capital, index fund rebalancing, and retail orders flood the market all at once.
It's like opening the floodgates on a dam.
So what happens to an algorithmic model when that dam breaks? The model has been calculating a structural bias all night based on thin futures volume. Suddenly, it is hit with billions of dollars of cash volume that might be completely contrary to the overnight trend.
The algorithm realizes its overnight data is no longer relevant, so it hits the reset button. It enters a bootstrap phase.
Exactly. It's recalibrating in real time. It's buffering.
Buffering, yes. It's buffering the new cash volume data to determine the true structural bias for the rest of the New York day.
Yep.
The reason it is still a Tier 1 asset, despite being in neutral buffering mode, is because the immediate alpha momentum is 100% bullish, and the price is hovering dangerously close to a massive breakout level. The kinetic energy is coiled like a spring. The edge is absolutely present.
But they won't execute until the buffering is finished.
Precisely. They are sitting with their finger on the trigger, waiting for the algorithmic bootstrap to complete and firmly declare, yes, the cash volume confirms the bullish breakout. The high priority setup, but it demands supreme, agonizing patience in the face of immense volatility.
Let's zoom out for a second and look at the systemic flow of what this entire board is telling us. We have individual charts and individual triggers, but institutional risk managers don't view these assets in isolation. They look at the interconnected global matrix.
The macroeconomic puzzle.
Exactly. Let's put the puzzle pieces together for today, April 27th. The NASDAQ is coiled for a bullish continuation. The Aussie is looking for a bullish continuation, despite having a bearish pre-market decision that it fought through.
Right.
The Eurodollar is also looking for a bullish continuation. If U.S. equities and major foreign currencies are all pointing bullish in the Tier 1 execution list, what does that structural alignment tell us about the U.S. dollar itself in this specific New York session? Oh, this is how you read the matrix of global capital flow. Currency pairs are a seesaw. If the Aussie and the Euro are structurally going up against the U.S. dollar, it fundamentally means the U.S. dollar is going down, it is weakening.
The fulcrum is shifting.
The dollar is always the fulcrum. And historically, a weaker U.S. dollar acts as a massive tailwind for risk assets like the NASDAQ. When the dollar drops, capital flows into equities.
Yeah.
So the Alpha Desk isn't just looking at a NASDAQ chart. They are reading the systemic weakness in the dollar across multiple foreign exchange pairs and using that as a macro confirmation that the NASDAQ breakout has real systemic backing.
Everything is interconnected. The desk is betting that the systemic dollar weakness will provide the exact lift needed for these Tier 1 assets to find that sustained acceptance we talked about. It really is a masterpiece of categorization. Let's pull all of this together as we wrap up this deep dive. Over the course of this preliminary document, we've journeyed from the sidelines of the Tier 3 observation room, diagnosing why global behemoths like gold and Ethereum are forced to sit and wait because their intraday geometry is broken.
Right.
We've navigated the paradox of the S&P 500, where a 100% directional guarantee still results in a wait order due to poor micro-entry dynamics. And we've stepped into the surgical execution zone of Tier 1, dissecting the exact triggers on the Kiwi and the buffering algorithmic patience required for the NASDAQ.
And if there is one ultimate unifying takeaway from reading an institutional document like this Al-Faroot report, it is a fundamental shift in behavior. Retail trading is an obsession with predicting the future. Institutional trading is a systematic process of categorizing current risk.
It is about demanding confirmation, respecting the time zone handoffs, and obeying strict invalidation levels without a shred of emotion.
The greatest mistake repeated throughout this entire battle plan, plastered across almost every single asset, wasn't picking the wrong direction. It wasn't about misreading the fundamental news of the day.
No.
The fatal flaw, the thing the risk manager warned against over and over, was simply trading without edge/without confirmation.
It is the failure of patience. It is the inability to withstand the discomfort of uncertainty.
And whether you are trading markets, managing a company, or just navigating complex decisions in your own life, you can apply this institutional patience. You do not have to execute on every idea you have.
You do not have to have an opinion on every headline that crosses your feed. You can place things in wait mode. You can demand sustained acceptance before you commit your time and energy.
Which leaves us with a fascinating, almost provocative thought to mull over.
Yeah. Think about the reality of what we just explored. We looked over the shoulder of a highly sophisticated New York trading desk. These people have millions of dollars invested in quantitative technology, proprietary data feeds, and algorithmic alpha models.
Right.
Their entire job, their entire existence as a firm is to trade capital.
Right.
And yet, they are perfectly willing to take massive, globally dominant assets like the S&P 500, gold, and Bitcoin and put them into a wait category simply because the math doesn't offer them an immediate asymmetric edge today.
They feel zero fear of missing out. The market does not control their actions. Their framework controls their actions.
Exactly. So if the professionals with the best data in the entire world are completely comfortable sitting out the dance, why do everyday individuals feel the constant crushing pressure to be active? Why do we feel we must have an opinion, a take, and an action on every single market movement every single day?
We want to be the hero in the triage center. We see the chaos and we want to rush in and fix it or profit from it immediately.
We want the action. But maybe, just maybe, the ultimate financial edge, and perhaps the ultimate edge in decision-making overall, isn't about having the smartest algorithm or the fastest trigger finger.
Maybe it's simply the capacity to stand in the middle of a chaotic room, look at the murky, conflicting data, and have the absolute ironclad discipline to sit on your hands until the picture clears.
Just a reminder, this discussion was based on a preliminary report. Al-Faroot publishes its final validated report daily at 9:05 a.m. Also, none of this is financial advice. It's purely for informational purposes to help you understand institutional frameworks.
If this briefing helps you, subscribe on YouTube and follow us on Spotify and share this episode to support the channel. We will see you next time on The First Coffee.